So I gotta ask you, what is it that you value? Because your values matter so much. A lot of people, when you ask them what they value, some people would jokingly say, cash. I value cash, as if this is what I value. Well, that's exactly what we're gonna talk about today. We're gonna talk about cash value. What is cash value? Well, cash value is commonly referred to as the money inside of a permanent life insurance policy. And that is right where we're going to begin. Let's dive in. So, cash value is a really important component, especially when we're talking about you becoming your own bank and using a process called the infinite banking concepts. Now, what is the infinite banking concepts? It's just a process. Forget about the whole life policy. Let's just talk about the process of you taking back the banking functions in your life. If you're gonna take back the banking functions in your life, you need to act as if you're a bank, which means you need to create your own private banking system, which always includes a permanent life insurance policy. And almost 100% of the time, about 99.999999999% of the time, that life insurance policy will be a whole life insurance policy. It is a specially designed and engineered whole life policy. It is a maximum funded whole life policy. Why? Because we want the most amount of cash value we can get. So that's what we're gonna go into. We're gonna talk about the cash values. We're gonna talk about how they're designed so they have the maximum cash value, because we want the most amount of money available to use for that process of taking back the banking functions in our life. You know, there's something that I value, and I thought this would be a good time for me to mention some of my values. I value all of you. I value one thing that every one of you did and every one of you should do. Click that subscribe button, and also while you're at it, smash that alerts button, because when you smash that alerts button, what it will do is it will notify you the next time I put a new video out. And if you don't, here's what's gonna happen. Oh man, that might have hurt. Sorry. All right?
Man, I gave that one to Josh Allen. I hope you know who Josh Allen is.
Anyway, let's dive in. So let's dive in and talk about that good old-fashioned cash value, because you should value your cash. Cash value is so important in a policy because it's what we can use. We can use it to invest in other things. We can use it to pay down debt. We can use it to buy cars and equipment in our business. We can use it to fund marketing campaigns if you're a business owner. There's nothing that restricts you from using your cash value. Nothing. It's not like when you walk into the bank and you want to take all your money out of the bank, they make you fill a bunch of forms out. Why are you taking the money out of the bank? Is that any of your business, bank teller? Like, it's my money. But you see, put money in a traditional bank, it's really not. It is your money, but you gave control to the bank to use it. So therefore, when you want to take your money back, well, they want to know why. And when you take your money back, you got to fill a bunch of forms out. What are you using that money for? What is it coming out for? Where's it going? And at the end of the year, they slap you with the best Christmas present ever. It's a little late every time, but they send you a 1099. Yep, whatever interest you made on that traditional bank account, you gotta pay tax on it. You're welcome, as if that's what they say to you. Now, cash value, if it's inside of a properly designed and engineered whole life insurance policy, well, then that money, when you earn interest and dividends on it, it's tax-free. So what do I mean by that? Well, let me show you an example here. You see, this is an example of a real policy that we designed for one of our clients. And this client, okay, I'm not gonna give you the age or anything else, but had $100,000 sitting in a regular bank. They actually had a lot more than that, but they wanted to deposit $100,000 into their private bank, which is the specially designed and engineered whole life. And they wanted that $100,000 to become cash that they can use, cash value. So we designed the policy to hold that $100,000. Now that same client wanted to make deposits into the future as well. They wanted to deposit $10,000 every single year, or have the ability to deposit $10,000. Now, when somebody tells us how much they want to dump in this case, $100,000, and how much they want the ability to deposit each and every single year, what we have done is we have come up with the base part of the policy design. We understand how much money the client wants to put in, so therefore we know how to design the policy for maximum efficiency. In this case, $100,000 with $10,000 will make an incredibly efficient design, but we have to build it to hold that, which means we need to add term insurance. So we had to put a term rider on this policy of $1.525 million. Now, term insurance, why do we use that? I did another video all about that, but it's because Dave Ramsey said, buy term, invest the difference. And what do we want to buy term for? Because it's cheap. So we wanted the majority of the death benefit to be term insurance because it's cheap. Now, why do we need all of that death benefit in the policy? Well, because there's IRS rules called the MEC 7 pay rule, which the MEC 7 pay rule said we needed a certain amount of death benefit to satisfy the 7 pay limits. Not only that, we designed the policy here to hold 55% into the paid up additions rider. I did another video explaining paid up additions rider. And then the base, it's all about the base, is 35%. So this is a 65-35 design. So you're probably thinking 55 plus 35 doesn't equal 100. Yeah, because the difference is the term rider. We got to account for that. Now, over here, what we've got is an incredibly efficient design. Efficient meaning your cash value will grow the most efficient way. And also efficient meaning you have the majority of your cash value to use. For example, in this case, you put $110,000, immediately this person in the first year has $103,661, of which they can access some of that $103,661 immediately in the first 30 days. Although it will be less than the $103,661 because that includes a dividend paid at the end of your policy year, it would still be close to that. So that's not great, right? Because in a bank, you can put 100 grand in a bank and you can take 100 grand out. Correct? Yes. But inside your policy's cash value, if you put 110,000 in, you only have access to 103,661, which is roughly about 94%. Why is that? Well, the difference is commissions paid to us, okay, which are reduced in this policy design by roughly 65%. That's right, we reduce our commissions by about 65% in this policy design so that you have access to 65% more cash value than you would in a regular whole life. Actually, this one, you have access to 94% more cash value than you would in that whole life policy that your broke-ass brother-in-law tried selling you, or more than likely in that IUL policy that your advisor said was the greatest thing since sliced bread, which you have basically almost no cash value to use in those early years. We're here, 94%. But you see, that's not the best part about the cash value. The best part about the cash value is in a design like this, the next year when we put $10,000 into it for our deposit, how much money do we have to use? $10,691. So we put $10,000 in, and out of that $10,000 we put in, that $10,000 grew by $691. Net, net, net. Net of commissions, net of policy service fees, and net of cost of insurance, which here the term portion is $1,098 a year. You see, we've got compounding interest happening. And here's the best part about the cash value in a policy. Let's just go back to year one. Year one, you have $103,661. Now let's just assume in the first year that we take $100,000 of that $103,000 out as a loan. So we take a loan from the policy for $100,000. How much money is left in your policy? Some people would say, well, 103 minus 100 is, I got 3,661 left. Wrong. You have 103,661 left, even though you have $100,000. Why? Well, because the insurance company didn't give you your cash value. The insurance company used your cash value, the 103,661, as collateral for a $100,000 loan that they allowed you to take out without any questions. You didn't have to apply for the loan. You didn't have to be pre-qualified for the loan. They didn't pull your credit. They didn't ask for personal financial statements. They didn't want to have you, literally drop your pants and show them what's behind the curtain, no pun intended. They just gave you $100,000. Why? Well, because remember I talked earlier that there's a death benefit, a total death benefit of $1.934 million that will be paid out upon the death of this client. But the insurance company allows this client to access in the first year $103,661 of the $1,934,982,000 death benefit. So this $100,000 that they gave you as a loan is an advance of your death benefit, collateralized by your cash value. You know what's so cool about that? Is it allows your money, all $103,661, to continue earning compounding interest. That's right, every year the insurance company pays you a guaranteed interest rate, plus a dividend. Although dividends are not guaranteed, this company that I'm referring to here has paid dividends each and every single year, never missing one, for over 140 years. And all the companies we work with are very similar. Never have any of them missed a dividend in all the years they've been around. That's some strength. So if you've got $103,000 compounding at an interest rate of over 5% with dividends, but yet you still get to use the $100,000, that sounds like it's too good to be true. But I left one thing out. The insurance company will advance you part of your death benefit while you're living, collateralized by your cash value, but they will charge interest on that money at a rate of roughly 5%. So now we got to go to the drawing board and do some math. So if they're going to charge you 5% simple interest, but you're making over 5% compounding interest and dividends, how much are you making? Just like a bank, you're making the difference, the spread. So mathematically, can we figure out the spread? Yes. The first year, your spread is negative. You lost money. That's right. In order to build your own private banking system, you will lose money in the first year or couple years. Why? Well, because of cost of insurance. The death benefit that they're giving you has a cost. We all know this to be true. Even term insurance has a cost. Not only that, every year the insurance company charges you a policy service fee. How much is that? Well, this company is $50 a year. That's right, $50 every year. Some of the other companies we use are $100 per year. That's the policy service fee. And then what's on top of that? Well, me and my team get paid a commission for building and giving you this policy. How much is the commission? Well, it's roughly about 55% of the base. So 35% of the 10,000, which is 3,500, okay, times 55%. That was our commission. But wait a second, Chris, you put 110,000 in. Yeah, but 100,000 went into paid up additions, of which we don't earn a big commission. We make about 2% on that 100,000. So 55% give or take on the 35% and roughly 2% commission on the paid up additions. That's our commission. All that came out of your cash value. Hence why you put 110 in and only had 103. But because we can use all that money and still earn interest and dividends on it and make a spread, let's go to the second year. Put 10 in, make $10,691. If we did the math, that means you made a net of $691. If we divide that into the 10,000, which gives us our cash on cash return, this is how you look at most of your investments, folks. You put money in, and how much money does your money make that year? You're only looking at the new money that goes in and how much that new money made, because the existing money that was in there, we sent that money out to work already, and we're still making interest on that, okay? So if we made 6.9% on this 10,000, if we took $10,000 out, how much did we make? Take 6.9 minus the 5% interest they charge you, you made 1.9%. And then we can keep going down. The third year, we put 10,000 in and we make 12,777. Remember, these returns stay the same whether the money's in the policy or loaned out and working for you a second time. That's why we use the cash value inside of these whole life policies to make you more money. It's called the infinite banking concept, folks. It's the process of taking the money in your private bank, this policy, and making that money go to work, paying off debt, buying cars, buying equipment, doing whatever you're going to do with your money, investing it in the S&P 500 for crying out loud. Some people come to us all the time and they say, Chris, why would I put my money in this specially designed whole life when I can put my money in the S&P 500 and make more? My answer all the time is, Why wouldn't you just change where the money went first? Put it into the policy, then take the money out and put it into the S&P 500. And then, brilliant person, you then can make money twice because you make a spread plus you make whatever the S&P 500 makes or whatever it loses. You see, the cash value, one unique thing about the cash value inside of a specially designed whole life, or any whole life for that matter, can only go one direction, and that is up. Every single year, you'll have more money than you did the prior year. Every year. No ifs, ands, or buts about it. Doesn't matter what's going on in the economy, doesn't matter what's going on in the government, doesn't matter what's going on in the Fed, doesn't matter about inverted yield curves or anything. You make money every single year. And that is guaranteed because the interest rate is guaranteed by the insurance company. I've been doing this for over 20 years, folks, and I've never ever seen a whole life make less money the next year and the year after that and the year after that. It's more every time. I've done video after video telling you that. But hold on. Let me just stop you for a second because I keep talking about all these other videos I've got. If you're just hitting this, I know you heard it once, but you're gonna hear it again, hit that little button right there. It says subscribe. And when you hit the subscribe button, there's another bell up top. See that little bell? Smash that bell because that bell will notify you every time I put a new video out. Then all these little terms, paid up additions and cash value and how to design an IBC policy updated and all the other videos I've done will make it really easy. See, I missed. Good. Make it really easy for you to get on par with how you can be your own bank. But I just want to go back to that one thing. Inside of a whole life, everything's better because now our money only can do one thing, and that is grow. You see, inside of a bank account, your money always grows, but if the Fed drops interest rates to near zero, just like they did back during the pandemic, how much does your bank account earn? Nothing. Do you remember those years? Many years. Money in a traditional bank earned 0%. How much did the money inside of a whole life insurance policy earn during those years? Well, I would tell you every single whole life out there before the 7702 change earned 4%. And now they earn between 2 and 3.5% guaranteed interest. That doesn't include the dividend. Hence why every single year the cash on cash return goes up. And look at these numbers. Year 2 was 6.9, then 3 was 27.2%, and then year 4 is 35.8%, then 43, then 103, 360%, 466%, 584%, and in the 30th year, 737%. Those numbers don't even seem real, right? Well, they don't seem real for somebody that doesn't understand compounding interest and someone that doesn't understand how compounding works. See, your cash value is always compounding. If we design your policy and it's designed properly, as I'm explaining how to do it, and I have other videos that will explain that, and at the end, I'll point you to one that will be great for you to learn how we design these, you can see that your cash value always goes up. But you had to give. Because in life, you reap what you sow. You must give before you get. What did you have to give? In the first year, you had to give up some of your cash. That's right, you put 110 in and you only had 103 here. And even if your policy doesn't look the same as this one that I'm showing you, which it very well may not, every policy is designed and engineered for that unique individual's needs and goals. So your policy more than likely will look different than this. Yours might take 2 or 3 years before it breaks even and starts earning a positive return, which is okay. So one of the biggest things I hear is when people see these returns, they see this cash value, they always say, that looks too good to be true. And to that, I gotta go back and I gotta just quote Earl Nightingale. Right here, Earl Nightingale says, and he says, I don't believe in circumstances. The people who get on in this world are the people who get up every day and look for the circumstances that they want. And if they can't find them, they make them. Saying that should make this creation make sense in your mind. Because this was designed and engineered. We created this for your needs and goals, for this client's needs and goals. And you see, needs and goals change. Circumstances change. And you gotta create the ones you want. One of the things that is very important to talk about with these policy designs and the cash value is although this person desired the ability to dump in $100,000 initially, put $10,000 in each year, but if this person falls short 1 year, and they can't do the $10,000. Something happens, the circumstance changes. We don't want this plan to fall apart. So the minimum on this plan was $3,500 a year. So they could have put $10,000 in and all the way down to as low as $3,500. Does that make sense over here? $3,565? That's how we designed the policy for maximum cash value. And I just demonstrated that to you right here. But if you can't believe that this is possible, then it never will be. Because what you believe is exactly what will happen in your life. I chose to believe this was possible. And ever since that day that I chose to believe that I could become my own bank, guess what happened? I have become my own bank. Not only that, I have used this concept and policy designs like this for everything I do in my life. I use this to get all the money back for every car I buy, drive, and own. I use this to buy that copy machine over there. Everything around you has been funded because I control my own money. I have my own private bank. But my own private bank is not a bank at all. It is a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends, and I max fund it so that I have the most amount of cash value that I can use for all the banking functions. There's one other thing I want to mention. I know we've been talking a lot about cash value, but I also want to mention that you also can set up policies, not just for yourself, but for your children. You could set policies up for your significant other, your husband or wife. You could also set policies up for a family member. Like I have set up policies for my daughter. I set her policy up when she was 6 months old. She's now 3. It's time for another one. Larissa has 3 of her own policies. My mother has 2 of her own policies, of which many of those policies I own. They make up my private banking system, but they were set up to benefit somebody else's needs and goals. Sometimes in life, you need to understand it's not just about you. Your goal in the short time that we have on earth is to solve somebody else's problem. So what are you doing to do that? You know, as we get to the end of this video, I always like to think about duct tape. You remember duct tape? When I was growing up, duct tape fixed everything. If your exhaust on your motorbike was falling off, you duct taped it. If your bike had a problem, you duct taped it. So I want to help all of you duct tape this idea of cash value life insurance in your mind. We're literally gonna make sure that this never, ever comes out of your head. And how we're gonna do that is we're just gonna take it and we're gonna literally take the cash and we're gonna duct tape it right to your head. And when we do that, what I want you to do is I want you to check this video out right here. This video explains how to design an IBC policy, and this is the updated one.